This is the Rocket City Retirement Show with Cris Wallace. Cris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Cris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hi, I'm Luann Fulmer, and we welcome you to the Rocket City Retirement Show with certified financial planner Cris Wallace. He's president of WG Financial Group. Also joining us from the firm, financial advisor Graham Bauer and certified financial planner Richard Constantine. All here today to give you helpful advice about retirement planning. Now, if you have questions, here's the number, 256-937-2010. That's the way to reach out to Cris. Complimentary, guys. It's complimentary. Now, we've made it easy. You may call or even text the word visit if you would prefer to do that. Text visit 256-937-2010. Again, this is a complimentary discovery session. Check us out on Facebook. Just search for WG Financial Group 256. Lots of things pertaining to our discussions there from our radio show. Any news headlines that happen during the week, Cris will put updates on that. And remember our motto, plan, retire, play. Find us online anytime at WGFinancialGroup.com. One other thing, our show is available on Spotify and Apple Podcasts. Search for Rocket City Retirement Show. All right, guys. So good to be here with you.
Great to be here with you as well, Luann.
Thank you.
So let's talk about you for a second.
What about me?
That sounded so much better than when I've done it the past few weeks. I enjoy radio. I enjoy radio, but I do not enjoy doing all of that, which is what you just did, which is fantastic. So for those of you who are tuning in this week, so let's talk a little bit about Luann and her absence. And basically, we were joking pre-show that I let her out of jail.
You locked me up. You locked.
Yeah, kind of like we've done Graham before,
yeah,
right?
Graham's done it too. Graham, yeah. I know how you feel, man.
I've served my time, you know.
Graham has served his time. Richard's yet to be in that in jail
Richard,
yet.
Your time's coming.
I haven't been in the doghouse yet, so
not yet. But in all seriousness, what we've done here the past few weeks, and it's been fun actually. We've received a lot of really positive feedback. Luann, just so you know, you have a lot of fans out there. We've had a lot of people request that you come back to the show.
Aw, thanks, everybody.
Really, what we're trying to do is just kind of alter the format just a little bit to make sure that it remains, listenable, I guess, if that's a word, to the majority of people tuning into the show. But we also want to have a lot of good information. So it needs to be easy to listen to, and we also need to have good information. And that balance, finding that balance, is sometimes rather difficult. It's difficult for us because now we have multiple people on the show. It used to be me and I did all the talking. Well, these guys bring some great viewpoints from their perspective. They're also sitting in meetings, client reviews, and having everybody's perspective on the show, I think, is really, really good. So learning how, as a group, us on this side of the microphone, just being able to work together as a team has been fun. It's been a little bit challenging. And again, that's why we decided to bring Luann back, because there's been requests and there's certain things that I just don't like to do. And so Luann does an excellent job at that. So with that, Luann, I'll hand it back to you and we can kind of get on with the show.
Yeah, okay, let's do it. So, we always, at the very beginning of our show, do current events, which I always love this. You guys can go back and talk about any articles that are taking place or that have taken place, any news that have taken place. So I think I'll just kind of hand this to Richard. Why don't you tell us about, just current events and any current market situations going on?
Yeah, Luann, thanks for that. So the S&P 500 and the NASDAQ, they have both been on winning streaks here recently. Both of them were up all of the month of May except for the last week. So last week was our first losing week in the market for the month of May. Year to date, the S&P 500 is up 10.64%, and the NASDAQ is up 11.48%.
Okay. Yeah, so the indexes are kind of ripping and roaring. And I want to throw something at Graham real quick that he, over the weekend, sent me a text. And he said that there were still some still some good news in the world. And Graham, do you need some help with this, or do you know what I'm talking about?
I know what you're talking about.
So I'd like for you to mention this. This was actually, I'm just sitting at home on Saturday, I think it was.
I believe Saturday.
And a text pops through, and, like I said, Graham said, there's still some good news in the world. So I'll just kind of hand it back to him.
Well, I guess we're not really doing WG positivity anymore, but this is still a positive story, I guess. So Costco, I believe they recently got like a new CEO or CFO or something like that. And he did an announcement recently that the $1.50 hot dog combo is still inflation proof. They will not raise the price. So it stayed the same since 1980, and we're getting no more raises, at least for the time being. So I was pretty happy to see that as a big Costco fan and a big Costco hot dog meal combo fan.
I bet it's getting is it shrinking?
Graham, did you know that the old CFO of Costco, that's who it is, he resigned because the CEO of Costco wouldn't let him raise the hot dog prices?
Yeah, there's a really great quote you can find from the CEO of Costco about that. I don't think is appropriate to say on air, but that he said about people wanting to raise the price of the hot dog. So it's definitely a sore spot for the CEO. Anybody bringing up the hot dog price change, but I appreciate it.
I think the CFO made the new CFO made the wise job security decision of not raising the price.
Yeah, that could have been a really short tenure, I guess.
Yeah, it's hilarious. So Richard, you there's some other things going on in the market that's been acting a little crazy this week with GameStop.
That is true. GameStop is, I've received more texts from people in my age group about GameStop in the past week than anything else that I could help them with. And, so for our listeners who are not aware of what's happening with GameStop, there's been incredible price fluctuations in the past 2 weeks that are mimicking what GameStop and AMC did back during the COVID pandemic. So it all started because people, the retail investors, wanted to get back at different hedge funds who had massive short positions of these companies who aren't really going to have a footprint going forward. GameStop and AMC, I mean, they're essentially dying companies. And because of that, hedge funds are taking positions that they want the stock price to decline. And the retail investors are trying to be like Robin Hood, essentially, and steal from the rich, et cetera, et cetera. So our words of recommendation are to ignore all of the volatility in GameStop that you're seeing, in any of our clients' portfolios and most of our listeners' portfolios too as well. GameStop will not be included in those index funds that you're purchasing. Overall, it really does not matter to you in the grand scheme of things. And we would strongly recommend not making the knee-jerk reaction and purchasing GameStop or AMC in hopes of making a few dollars on the volatility, because in the reality of it is that no one knows when this stock is going to come crashing back down to where it historically is and where we feel is a more comfortable range for it to be.
I think it's a good way to get hurt financially if you're like jumping in trying to time this, and I just don't.
It is.
Yeah, it's incredibly risky. And to your point, I think in the long run, it doesn't matter. Just stay diversified, stick to your plan. These are shiny objects, and you can get burned and cut in some places, in some cases, reaching for that shiny object. So let's move into consumer spending data that came out this week. So you saw real personal consumption expenditures drop by negative 0.1 month over month. So that was below expectations. And, a few weeks ago, I mentioned GDP, and that number has been revised down. I think when I mentioned it, I believe the expectation, according to the Atlanta Fed, was, I want to say it was around 3.2%. It has since been revised downward to 1.8% as of a few days ago. So you can see that there's there could be some stresses on the economy. You're looking at the consumer spending dropping, GDP being revised. So it's going to be an interesting next couple of months. And I think as we just kind of take a look at what's happening in the economy, I think that you have to wonder, are the elevated rates, or have the elevated rates that have been in the economy now for a while, are they starting to take effect on the consumer? In other words, with things being more expensive to buy and finance today, are people starting to run out of money, starting to run out of credit card room because we've seen credit card debt go way up? And are we starting to see just the rates start to take effect? And I believe, just personally speaking, that when we think about how long they've been elevated and look at how fast they were elevated, I just wonder if just the time horizon is different than it has been in the past. And now we're starting to see that kind of take hold. So that'll be interesting to watch, I think, as we kind of move forward.
Yeah, I agree with you, Chris. I think it's going to put a little bit of pressure on the Fed to make a decision here in the near future. When I say near future, I mean by the end of the year, if rates are actually going to be cut. Because like you said, I think consumers are starting to run out of excess funds, and the rate cuts are going to be back in play again.
I want to take this time right now to make sure you have our phone number. If you have any questions about what Chris, Richard, or Graham are talking about today, right now, we're talking about the market. If you have any questions about this, certainly give them a call. But that's what the show is all about, to help you, give you guidance about retirement. The phone number is 256-937-2010. Okay, you may call that number, set up an appointment. It's complimentary. You can also text the word visit, same thing. And then what's going to happen is you'll get a request form, especially if you visit the website, wgfinancialgroup.com. Fill that out, and then you can set up the appointment that way. So call, text, or visit the website, okay? Those ways are ways that you can reach out to them, and they would love to help you with your retirement. And just head to wgfinancialgroup.com and find out information there. There's resources at your fingertips. Also, remember us on Facebook, WG Financial Group 256 too. Great information there. So we just want to thank you so much for joining us. This is the Rocket City Retirement Show, and I'm Luann Fulmer. We're talking today about investing in retirement. So we're so happy to have you along. Last week, you guys covered the R in the Rite Retirement process. Chris, that's your process that you take. Well, all of you take the retirees through Rite, R-I-T-E is an acronym. So the R, of course, is retirement income. And, of course, that's the stable foundation piece in a retirement plan. And, it can just allow you to extend your investment time horizon. So you want that. Everybody wants that, stable, reliable, and guaranteed income. You want to allow your investments to grow and a longer time to grow as well. Now, this week, what we're going to do is look under the hood at the engine of your plan, and we're going to look at your investments. That's the I in Rite Retirement process. So, Chris, you spelled it wrong, right? But you know that. Well, actually, it's R-I. That's not wrong. That's wrong yet. It's when we get to the next letter.
Right. Purposeful,
I'm
course.
teasing you. But, okay. So I love acronyms anyway. I want to get to, investments. Is there an emotional component when it comes to investing? It seems like there might be with so many different people.
There is. And I think there's a wide variation on the emotions. And I think some of it can stem from politically. It can be the way that you were raised. It could be, people that you follow, listen to, read, their literature, whatever the case may be. At the end of the day, we all have a bias in us about just things in general, but especially when it comes to our investments. And then also when you talk about just politically speaking, it can cause what I would call some irrational behavior. So there's 100%, there's an emotional component to investing. And honestly, and we've talked about this on the show before, at times, I think in the office, we feel like we're kind of like counselors in a sense. Now, obviously, we're not licensed counselors, we're licensed advisors. But part of our job is trying to help our clients and even prospects behave and not think irrationally and make decisions that can have short and long-term lasting effects when it comes to their money and how they invest. So we 100% believe that. And frankly, it's not just us. That's why the whole behavioral finance thing is a big deal these days, is because advisors need to become more in tune with the behavioral side of things so they can recognize certain behaviors and, again, help clients essentially protect themselves from themselves, essentially.
Yeah, and I think that a big key piece of the emotional side of investing comes in because, I mean, this is kind of stating the obvious, but sometimes people might not think about it. I mean, your investments, they're not just your investments like your stocks or your bonds. They're not just stocks and bonds, but they're your money. You know, you put your money into those things, money that you worked for, kind of your blood, sweat, and tears. So I think that personal aspect of it being your money, when it's moving up and down, it doesn't feel like the price of Apple or Microsoft or any company moving up and down. It feels like your money moving up and down. I remember it kind of made me think of this when you guys mentioned GameStop a little bit earlier. I was in an economics class the last time that GameStop had that crazy boom. And it was actually during a semester where we were doing this thing where, you know, you kind of like trade with fake money. And I just remember like at that time, so many people were just in the class were just throwing all their money in GameStop because it wasn't real money. You know, it wasn't actual money. It was just play money that we were using for a class. You know, my now wife, then girlfriend Emma was in that class, and she lost like so much money, fake money, obviously, in that class, but she didn't care. It was fake money. It wasn't like you didn't work for that money. A teacher just said, "Here's your, you know, fake stock trading account and go crazy." So that personal aspect, I think, is just what adds so much of the emotions for people.
Yeah, when it's your money, you know, going into it, that's a big deal. I mean, it starts to become, you know, to your point, a lot more personal.
Let me ask you this, you know, with everything going on right now, do you think people should react politically with their investments?
Well, I'll kind of speak here. We think politically speaking, we think people should really not look at their investments with their political lenses. I've talked about this a number of times on the show, that all of us have a political prescription. And depending on the strength of that is, sometimes can affect the way that you look at your investments. So I like to say you have political lenses and you also have 401k lenses, and you should never put them on at the same time because they have different prescriptions and things just won't line up the way that you, in your mind, you want them to. And I have personally seen, and I'm sure the guys can attest to this as well, I have personally seen where bad decisions are made because they don't like a political figure. And it doesn't matter whether it's right or left. I mean, you can take, for example, when Trump got in office in 2016, how did some people react? Again, and you had some people on the right kind of freaking out at that point because it was new. But, in looking at that, they forgot about other things in the economy that they should be looking at. The same thing when, Biden got elected. There were a lot of people that wanted to go to cash. And there's a lot of people listening to the show today that went to cash, and some of them still are in cash today. And when you start looking back over the last 3 years at what the market has done from the S&P perspective, you kind of have to start questioning yourself, did I really make the right decision? Well, it may feel like you did because you don't like a person, but what about your money? Because that's why you invest. You invest typically to grow your money. So personally speaking, I think being political with your investments is a risk and one that can kind of hurt you long term.
And I think you kind of have to remember, to your point, Chris, that politicians are temporary. You can look at politicians, but at least for president, obviously we don't have term limits in the Senate and House and all that, but I don't feel like people are usually quite as stressed about that as they are about the sitting president. That's 4 to 8 years, depending on the president, and your retirement plan is going to be a heck of a lot longer than that. So, looking at the one piece of information and, making a mistake that could cost you down the line is definitely something a lot of people, I think, struggle with, especially when you get to the later stages in life and nearing retirement.
As someone is investing, throughout their working years, they're spending time investing, hopefully earning money and putting that, those dividends away in savings. As they get closer to retirement, that's when I think people tend to get a little bit scared and worried about taking on too much portfolio risk. So I want to give that one to you, Richard. Tell us about, what people should be doing with their money as they're approaching retirement and their investments.
So, when people start approaching that retirement years, what typically makes people, or from what we've seen, and with this recent S&P 500 boom since back in 2010, it seems like the people who are coming in with the most amount of assets are the people that are 100% equity. And while that was great when you were, contributing to the fund and that you had the luck dash benefit of the market growing significantly, it helped grow your account balance to what it is today. Part of our job in retirement is to make sure that you stay wealthy. It's not about getting you wealthy, but it's about making sure that your funds do not run out during retirement. And so we do want to start dialing back portfolio risk about 36 months to 18 months away from retirement. But Luanna, on the flip side of that is, we think that you should always be aware of what your quote unquote risk score is. We do not want a young client or a young investor to be too conservative in their portfolio.
Yeah, because they have the longer time horizon. So, and I think, I've seen it. We've met with people. We've had people come into the office. I've just had conversation at the gym and in passing with younger individuals who are, very concerned with the political landscape or just the economic landscape. And I'm like, you're 30 years old. Like, you don't need to worry about that. But Richard, you said something else that I really, really liked. You said the luck / benefit. So I want to take the luck word for a quick second. In order to be lucky, you have to put yourself in a position to be lucky. And I look at it, if you want a blessing, you have to put yourself in a position to be blessed. And luck kind of works the same way. So, I like that you said that. And you said something else that I really, really like. That's really part of our job. There are people that come to see us and they're wealthy, and wealthy is a relative term. When you're coming into our office, having a conversation with us, wealthy could mean many different things, but let's just talk about the money aspect for a second. So $400,000 with one family, they're wealthy. And by my standards, $400,000, having that in retirement savings, that would be, I would consider that wealthy. But that job of ours, or the job of ours in the office, is to keep you wealthy. So you've worked all of these years, putting yourself in a position, as Richard said, to get lucky or having the benefit of being in the market, invested long term. Part of our job, and really our main job, is to keep you that way, to keep you wealthy. And I thought that was an excellent point that you made, and I just wanted to chime in there.
Oh, well, thanks, Chris. And if you look back at the S&P 500 throughout history, there has not been a period in time where a dollar put into the market is not worth more than $1 10 years later. And so it's one of the easiest ways to quote unquote get lucky. And so that's why it's very critical for younger people to not think with emotions, to not think with your political glasses, and to stay invested in the whole picture of investing.
You're listening to the Rocket City Retirement Show. I'm Lou Ann Fulmer. I want to make sure that I get this number in here because we are offering a chance for you to go in and see these guys that you're hearing right now on the radio. They are here for you to guide you with your retirement, with your investing, with your emotions about investing. This is what they do. 256-937-2010. That's the phone number to call, or even text the word visit. You can do that and set up an appointment that way. You'll get a bounce back on that text and leave your information that way, or give them a phone call, 256-937-2010. Get on their calendar. I want to also mention this. If you are the owner, president, maybe an HR person of a business, Chris and his team would welcome the opportunity to hold a lunch and learn for your employees, and he does this complimentary for businesses right here in Huntsville. So Chris can help your employees better understand some of the more complex things about retirement savings, and he would love to just guide them and ensure that they are on the right path to a successful retirement. So again, just call 256-937-2010 and schedule this complimentary lunch and learn for your employees. And thank you so much for joining us. This is the Rocket City Retirement Show. I am Lou Ann Fulmer, and we are talking about the I in the Rite Retirement process that Chris and his team take you guys through. It's a plan, okay? A plan for your retirement. Talking about the I part, which is investing. So let's get to this then, Chris. You talk about diversification, okay? Explain exactly what are we diversifying? Be specific on that, please.
Yeah, so I can tell you what it's not.
What
it's
is it
not. It's not having 3 or 4 financial advisors. That's not diversification.
There you go. Yeah.
Because I've heard that before. I've had people come in the office and say, I have 3 different advisors because I'm testing them against each other and I'm diversified and I don't have all my money in one place. It's not about diversification across financial advisors. It's about the asset class diversification. So having exposure to large cap growth value, small cap value growth, in having those different buckets within your investments. That is really what diversification is. And that's one of the things that I want to kind of roll into target date funds here. If we look at target date funds, they were created to really help people that didn't really know how to do investing, because inside of 401k plan, you have just a very small selection of funds to choose from. So with the target date fund, what they've done is they've created these funds that you can kind of match your investment time horizon to retirement. So if you were, picking a 2035 fund today, that's kind of like saying that you're going to retire in the year 2035. Now, what that does inside of those funds, it does give you diversification. It also, over time, adjusts, as you get closer to retirement, those funds will essentially adjust more to bonds and probably less heavy in stock at that point. But I also say that they're kind of the devil in disguise. And, the reason I say that is there are target date funds that are 2025 funds, which is, hey, it's 6 months away. And what you see here is they still have a heavy equity exposure.
Yeah, I can remember actually one scenario where we met with a couple where they were looking to retire in like a couple months and they had most of their money in a 2025 fund. And I think it was like 70 plus percent equity exposure. And they thought they were really conservative because they picked this fund and, people just don't really look into it quite as much because you're like, oh, I can pick this year and go ahead and go there. But even on the flip side of that, in one article that was kind of talking about them, they mentioned that for one of the more popular target date funds, even for the 2060, it was only about 90% stock and had 10% bonds, which, like we were mentioning before, if you have 35 years to retirement, do you really need to have any sort of like fixed income or bonds in your portfolio at that point? You got, 35 years to grow. So for both sides of the spectrum, they can be a little bit deceiving.
Yeah, but Graham, I also think, and I think that for the majority of people, they are better than trying to create something on your own. But I do think to both of your points that if you're working with someone, you have a lot better options than the target date fund presented to you.
Yeah, I'll just kind of chime in here. Yeah, I totally agree with you there, Richard. I think at times you can build essentially your own target date fund to where you can take the available funds because what we've seen lately, and I've seen this a lot in the past 10 years, is the target date funds tend to be very, very heavy international. And I know we're not driving in the rearview mirror here, but if you look at what's transpired over the last 10 years, the U.S. economy and U.S. funds have outperformed, the majority of foreign funds, of those that have been, found in those 401k plans. So as we get ready to wrap up this little segment here, I just wanted to again thank everybody for listening to the show today. Luann, we are glad to have you back on the show, kind of handing this stuff off so I don't really have to think about it. And, we're at the point now where I think we want to transition more into, do we or should we own stocks in retirement?
Get the most out of your retirement with WG Financial Group's comprehensive investment and wealth management services. While we don't fully endorse active investment management, we believe in regular portfolio adjustments to potentially achieve better returns for our clients. Schedule a meeting today by calling 256-937-2010. That's 256-937-2010.
Wait. Now, wait a little longer. Great. You may have just increased your lifetime income by tens of thousands of dollars. That's how Social Security can work for you. The longer you wait, the more money you may get. Deciding when to start taking your Social Security benefits is one of the most important retirement decisions you'll make. Cris Wallace and the team at WG Financial Group can show you the options and help make the right decision for you and your situation. Call them today, 256-937-2010. You spent decades paying in. Optimize what comes out. Cris Wallace and the WG Financial Group team can help you squeeze every penny out of your Social Security benefits. Don't wait any longer. Call now, 256-937-2010. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm is not affiliated with the U.S. government.
Don't panic in uncertain market times. Let Cris Wallace be your trusted guide. Call Cris Wallace today at 256-937-2010 for expert advice and support. That's 256-937-2010.
So, Luann, I want to hand it back to you because you're nearing that age of retirement at this point. And I'm not trying to call you out on the air, but we've talked about this before, right? Yeah. And I just wonder, as we get ready to kind of toss around a few more questions here and go into some topics, how are you and Bobby dealing with stock market risk these days?
We kind of don't know what we're doing. We don't know what we're doing. Bobby's so scared about losing money. We are trying to just kind of keep what we have. So I would say very conservative. And we have, our 401ks, our IRAs, they're growing. And what he's doing right now is trying to, convert things over to Roth IRAs is what we're doing.
Oh, really?
Mm-hmm.
Okay. So just so it's clear here, we do not manage Luann's money. I just want to make sure the listener knows that. We don't have any financial relationship with her. We love her to death. She's been a long, long time friend of mine, but we do not manage her money. So I'm going to kind of put you on the spot here, Luann. This is what's great about the show is, do you guys currently, do you have a financial advisor that you work closely with?
Not really.
Not really.
So what we have is a friend.
Okay.
Who's our insurance person. And we know that we need to, you get somebody more focused on retirement. But so we're just I'm learning, I always take notes from you, Chris. And I've been telling Bobby we need to, try to change some of our traditional IRAs into a Roth, things like that, just so we can pay the taxes now while we're both still working.
Yep.
We're both going to work till full retirement age. So for me, it's 66 and 10 months, which I know that from you. So anyway, just to give you an idea of what we're doing. Yeah.
Gotcha. So you know what? I want to pass this first question to Richard, basically. With what we see, and listening to Luann. So first of all, thank you for just being vulnerable on the air and letting me ask you like a blindsided question, a very point blank question. Thank you for that. So Richard, what is your opinion on owning stocks in retirement?
Yes.
Yes, to do it.
Yes, absolutely. There should be a portion of everyone's portfolio, no matter the age, that is invested in equities. Not suggesting that everyone be 100% equity throughout their whole life, but there should be some component of a well-diversified portfolio that is invested in stocks throughout one's retirement. Because
that is for growth. Stocks are generally looked at as a growth vehicle, right?
Correct. That is what's going to make sure that you outpace your withdrawal rates, essentially.
Yes.
Back to the 4% rule, Chris, that you and I talked about a few weeks ago, those models are based off of 50% stock, 50% bond portfolio. And even in that situation, we saw that there were instances where people did run out of money. And that was because the stock market did not perform as well as it could have. But if you also look into the data, when you transform it from a 50-50 portfolio, 50% bond, 50% stock, 25% bonds, to a 75% stock to 25% bonds, the success rate actually was a little bit higher. And so that's why it's critical that you do have some growth inside of your portfolio throughout retirement. So one, you can maintain or really keep up with inflation at that point.
I was waiting on you to say the I word. That is one of the best ways to outpace inflation. I know a lot of people think, well, we should buy gold for inflationary reasons. No, you should own stocks in the long term to outpace inflation. And that's, just the data proves that time and time again. We have charts in the office. I've showed people on, various charts where you've got stocks long term just really blowing away precious metals.
Okay, so let's get into this rule of 100. And, I know about this. What's your age minus 100 is the percentage of stocks you should own. So do you guys still use that sort of rule of thumb?
Honestly, out of all of the rules of thumb, I think this is the dumbest one ever.
Really?
I think it's the dumbest one ever. Yes, I really do. Like, I love rules of thumb because I think there are times when you need to estimate, and then I think there's times when you need to get granular. To me, this rule makes no sense. So I'll give you an example, and then I want to hand it to Richard. Let's just say that I'm age 70 and I'm in good health and I have a federal pension. My wife has a small pension, and we have both our Social Securities, and all of that income covers all of our necessary spending every single month. Why in the world would I at that point want to have 30% exposure to the stock market? Because 70 minus 30, I should have 30% in the stock market, according to the dumb rule of 100. If I'm covering all of my living expenses with guaranteed income, I've essentially increased my time horizon, and that money is really going to be my kids at that point. I'm probably not even going to spend it all. So why in the world I would want to be sitting with only 30% equity exposure makes no sense at all. So I do not like the rule.
No, I'm with you, Chris. It's an outdated rule that should never have been a popular rule to begin with.
No, I agree, Richard. I'll say something a little bit more. Gosh, I get kind of passionate about when things are just make no sense at all. I get even more fired up. Technically speaking, and again, I'm not advocating for this. I'm talking from a mathematical sense and also a life expectancy sense. I think you should be less aggressive at age 60 and you could be more aggressive at age 80. Why? At age 60, we need our investments to last a long time, assuming we live a longer than average life expectancy. But if we're 80, 85 years old, our time horizon on this earth is pretty short. We're probably, assuming you still have a portfolio, you're probably not going to run out of money. I think it's the exact reverse of the rule. You could be more aggressive when you have less life expectancy, but the tendency is to become more conservative. So here again, I think it's all about goals, objectives. What is really the long-term objectives with a portfolio?
Well, Chris, you're exactly right. I mean, there's been clients that I've interacted with here in the office who are living off of completely their pensions, Social Security, disability, et cetera, annuity incomes. And so really their investments are designed to the risk tolerance of their beneficiaries. So their accounts are significantly more aggressive than what they would be if the guaranteed income that they have coming in was not around.
Correct.
Let me ask you guys this. Are there costs to owning certain types of investments?
There are. There are. It depends on the type of investment. So, if we just start with like the stock, just if you bought a share of like Apple stock or whatever, there's essentially no cost to owning that. Your cost is opportunity. Your, opportunity you may lose and
risk.
Opportunity you may
Yeah.
gain. Right.
Yeah.
Risk. When you get into like mutual funds and index funds and ETFs, there are what they call expense ratios that are associated with those funds. And then when you talk about, just products in general, maybe you're looking at an annuity or life insurance products, there are going to be internal costs embedded into those vehicles, and it's important to know that. So I think there is this misconception that, especially like with 401ks, you've got just the average, very hardworking individual worked hard all of his or her life, and they're just like pumping money into those 401ks. I think the misconception is that there's no cost associated with those investments, or there's no cost associated with the plan. It's just a place you put your money to save, which that part of it is true, but there is a cost there, and a lot of those funds do have costs embedded in them, especially those mutual funds. And I just think it's important to realize that. So, there is cost, Luann. So don't think that there's not.
And to your point, Chris, it can be hard to find out exactly what those costs are for the average person. Because, in your 401k or even some IRAs, it's not like, you might log on and see your balance, see your return for the day or the month or the year or whatever. You're not going to probably see expense ratio right next to that. It's not something that's highly advertised. So, for people who are working, I think it's a good thing to know when you're picking funds in your 401k. We actually were working on onboarding a now client about a week or two ago. And, we had kind of gone back and forth a little bit. They were a little nervous about, paying a fee. They hadn't worked with an advisor before. And after that meeting, got a statement for their old 401k so we could kind of work on getting that amount rolled over. And their expense ratio was, about 60% in there of what our advisory fee was, that they were paying for no advice, no extra anything, literally just the mutual funds. And in that, they could have even been getting very similar funds for cheaper within the 401k. So it's a good thing to know about. And if your advisor has never talked to you about it, you should know what you're paying in expense ratios. You should know what you're paying for their services, but you should also know what your internal expense ratio is, because that's an important thing. And sometimes it's much higher than you might think it is.
Here's something we see at the office quite a bit, actually. So to your point, Graham, number one, you should know what you're paying your advisor for their services, and you should know the approximate amount on average that you're paying for the whole basket of funds that you're invested in. That's incredibly important. That is the number one question that we get when somebody comes into the office is, what do you charge? Mm-hmm. And what's always funny is they don't know what they're currently paying. They want to know what we charge, and we fully disclose all of that. It's, we have to, and we do, and we're happy to do that. But most of the time they have no clue what they're actually paying their current advisor. And I just kind of find that funny. But to your point, Graham, about the couple that we were onboarding and the expensive funds that they owned being, a good chunk of what we charge on an annualized basis to work with a family holistically. So what we've seen is, in some cases, we've had a family go to, just say, a brokerage firm. We'll just call it brokerage firm A, and they've been sold a basket of commissioned funds. So let's call it front-loaded funds. They're A-share funds. So they paid a front-loaded commission to get in it, and they have, let's just say 5 different mutual funds at that point. And they've been in those 5 different mutual funds for 15 years. Well, I know over the last 15 years, there's been changes in the economy, but what we've seen is, and we can tell this by looking at their trail of statements, if there's been any changes to the funds. Well, there hasn't been any changes in a lot of cases. The reason for that, our opinion is that those funds were sold on a front-loaded commission, and they were just kind of sat there, and they were never looked at again. And so in the mind of the investor, you think, well, I'm not paying a fee. Yeah, but you're also not readjusting and rebalancing and moving some of those, asset classes around that need to be moved around. And I'll give you an example. Like, if you just think about when the pandemic started, where the 10-year treasury was and how the feds crashed the rates to zero, that was a prime opportunity to adjust bond durations in the portfolio. But if you're just sitting in a particular fund, a basket of funds or basket of mutual funds with no rebalancing and nobody looking after it, and your expense ratio is, let's just say on average 0.7%, you got to start asking yourself, is it worth it to pay somebody to kind of help me with that? So great stuff there, because we see all of this. But main points here that we want you to take home from this: you need to know what you're paying your advisor. And if you're quote unquote not paying your advisor, somebody's getting paid. And those mutual fund managers, they charge an expense ratio. And you got to start asking yourself, do I have a relationship with those people who run those funds? Are they bringing me value? Are they looking at the taxation of how I'm going to pull money out and what I'm going to owe in taxes? Are they assisting me with my Social Security claiming strategies? Are they really looking out for the best interest of my family? Those are the type things that we do at the office from a holistic standpoint. And those individuals and families sitting in just a basket of mutual funds, what value are you receiving for those fees that you're paying? That's really the big question, is the value question.
256-937-2010. That is the number to call if you would like to go in and have that discovery visit with Cris and his team at WG Financial Group. Cris is a certified financial planner. He's gone through the education And then, of course, he and his team, financial advisor Graham Bauer, certified financial planner Richard Constantine on our show today, they all are involved in the process, taking you through this Rite Retirement process and making sure that you have that retirement plan that you need. You've got to have a written plan for retirement. That's what this show is all about, to help you achieve that. We thank you so much for joining us. This is the Rocket City Retirement Show. I'm Lou Ann Fulmer. Make sure you check out WGFinancialGroup.com and WG Financial Group 256. That's on their Facebook as well. Great information there. So we are really unpacking this Rite Retirement process. And, the R is retirement income. And the I is investing. And so Rite, R-I-T-E, is the name of Chris's process. And I tease him, he didn't spell it right. It's an acronym, R-I-T-E, but there's a reason for that. So, all right, we are talking about investing today. And I guess I'll go back to the volatility we experienced in 2022 after, the pandemic, and then now experiencing interest rates higher. This is an election year. Right. So there's probably a lot of people who might want to just sit in cash right now. So I guess my question is this a good thing, Chris, or not?
Yeah. So let me dive into something else just real quick, just to bring further clarification. So on the show today, we're talking about the investments, as you mentioned, and the I in the Rite process. These things that we're talking about, this is what we do for people's retirement. We take all of their investments, and we'll do an analysis on those. We'll run a risk score on those. We'll run a investment fee analysis. We'll basically uncover what you're really not sure about to really show you how you currently sit, because your investments are really important when it comes to your retirement. It's kind of the engine, as Richard was saying earlier, the whole growth, and we need stock exposure to be able to grow in a lot of cases to outpace inflation, to really help the portfolio grow, and just to help your, overall net worth grow as well. That's important, and outpace your withdrawal rates and such. So one of the things I do want to, before I answer your question, Lou Ann, here, I want to just touch on the difference between a mutual fund and an ETF. So the first thing that I want to say here is just kind of in your head, I want you to picture a basket of, just a basket. And maybe inside of that basket, you have to be careful that maybe you have eggs in that basket. And so again, you have to be careful if you got those eggs in the basket, but just kind of picture a basket with a whole bunch of eggs in it, and each one of those eggs representing a stock. So with a mutual fund and an ETF, you're basically owning a basket of positions. And when you think about that, that gives you that diversification. We talked about diversification earlier. So what an ETF and a mutual fund do, and what they have in common, is they are just essentially a way to diversify yourself. I like to think of them as like cousins. So when you look at a mutual fund, again, for diversification, it's a basket of stocks, and ETF would be the same. The major difference is the ETF is actually traded on the exchange like a stock. So you can do a lot of things with an ETF that you can do with a stock. You can't really do that with a mutual fund. A mutual fund, the net asset value is calculated at the end of the day after the market closes. So if you were to trade a mutual fund, you wouldn't know what the net asset value was until the end of the day, versus an ETF. You can kind of know within just a few seconds after you sell it. So that's one of the major differences there. ETFs are, really designed to track an index for the most part. So you've got, if you're looking at the S&P, if you have an S&P ETF, it's going to mimic what the index does, and it's pretty cheap to do that. It's pretty cheap to own an ETF versus a mutual fund, which is usually ran by an active manager trying to outperform the index. They usually charge a little bit more. In some cases, they charge substantially more to try to beat the index. They beat the index at times, but more often than not, according to research, they actually fail. So it's usually better to own an ETF. We are in favor of owning low-cost ETFs in a portfolio. Helps the client save on cost. It also gives them an index to track. And if you do any research at all, Warren Buffett is like a major proponent, and he promotes index funds and ETFs just because of trying to really outperform the markets.
No, exactly, Chris. And also kind of the way that I like to explain it to clients is the mutual fund is the archaic version of an ETF, essentially.
Yeah, I agree. Good way to put it as well.
All right. So do you want me to go to this question here about just whether or not people should be sitting in cash right now if they're just afraid of what has happened here.
Well, that's why you're back, Luann, because you know what? I forgot that part of the question. So, yeah, so with all the volatility back in 2022, we've seen higher interest rates and selection year, and we talked about emotions, and there's that emotional component to investing. And, sitting in cash long term is a really bad idea. So I'll make a case for cash. Let's say you have something that you need to do in the short run, let's say the next 6 to 12 months. For sure. Have money in a CD, money market, making a pretty good interest rate. Absolutely. But sitting in cash long term, trying to time the market, it's not going to work long term. It's after you reach a certain point in years, I think Richard kind of alluded to this earlier, you're much better off to be in stocks. So if your time horizon is long, so remember, we talked about this last week. We've mentioned it a couple times on the show this week. Time horizon is key here, right? So if your time horizon is long, you should be invested in the market so that your money, grows long term. But that emotional, situation in your brain and in your body starts to take over, and it starts to create some bad decisions. So, we're not advocates of sitting in cash long term, but there are certain circumstances where you need to have cash. And if you're looking at a withdrawal rate in a retirement plan, then let's look at maybe a combination of some safe assets early in retirement when you're much more likely to spend money. If you're nearing retirement, you're a couple, 2-3 years out, it's still not a reason to be in cash. It's a reason to formulate a plan at that point. And I think that's what we do a really good job of here at the office, is kind of walking people. I'm terribly afraid of heights. I've told a story before where I was in Colorado and I wouldn't walk up to the edge of the mountain because I didn't want to get too close to the cliff because I'm terrified of heights. Well, that's part of what we do, is kind of help you get a little bit closer to the edge with your retirement plan, so you can, achieve the results you're looking to achieve, but also have your money last throughout your retirement.
Yeah, and Chris, you said it really well. Being cash for a short period of time isn't necessarily a terrible thing. But the hardest part about that is determining when it is to be back invested and to exit your cash position. Right. And so most people struggle with that. And, for people trying to time the market, most of the time it fails. And so, as we like to say, time in the market is going to be timing the market.
Yeah. Time in the market. That's time in the market is absolutely correct, Richard.
Very good. Good explanation. So I want to get to bonds for just a minute. Graham kind of talked about them moments ago. Are bonds safe for times like these?
Well, I think bonds, if you just look at the risk of bonds relative to stocks from a history perspective, they're a lot safer. Let's call them safer. It doesn't mean that they're completely safe, because we've seen we're kind of what we're in the middle of right now. We're in the worst bond bear market in history at this point, seeing how interest rates have risen, and we've seen bonds be negative for multiple years in a row now. So are they safe? It depends on what your, definition of safe is. So the way I like to say it is that they're safer. The volatility of bonds are a lot less than it is, compared to a stock. I would also just remind everybody that when it comes to bonds, it's not necessarily the B word that's bad. Usually it's the duration period that's within those bonds that really determine the up and down movement relative to interest rates. So I would say that they're safer. And then today, I think you have to, when you're looking at just a normal stock bond portfolio, I think people should look at other tools out there for diversification to really diversify away from some of that risk.
Very good.
Well,
So, yeah, go ahead.
Chris, you said it really well. It's the duration of the bond that's going to classify it as risky or safe. The aggregate bond index as a whole. So the aggregate bond index is a combination of all different bond types of maturity - duration. And overall on the year, that is down. But if you look at just short-term bonds, they are, if you include the coupons that they're paying, they are actually positive on the year. So it's all about the duration of the bond, like you said.
Mm-hmm.
Now, are all of the bonds the same?
No, they're not. Actually, I think Richard just kind of alluded to that, just in case the listener didn't catch that. So I'll just kind of, what Richard was talking about, the shorter duration bonds, if you include the coupon they pay, and they're actually positive for the year. So they're not all the same. And, that's why I say, hey, when it comes to bonds, it's not the B word. We talk about the A word on the air. We'll talk about the B word now, and we're talking about bonds. It's really not the bonds that are the problem. It's the duration within those bonds that causes the up and down movement.
So should retirees consider, where we are in an economic cycle when it comes to when they decide to retire, because so many people might go, I think I'll wait. But do they want to wait 10 years? I don't think so.
Yeah, that's a really interesting question. So I think sometimes it's kind of hard, number one, to figure out where we are in the economic cycle. Like right now, are we at a market top? Are we at a market bottom? Or are we kind of midway in the expansion cycle? I think sometimes that can be really hard to determine. I think if you're a retiree today and you are considering retiring in the next 5 years, I think you have to start looking at sustainable ways to generate income, specifically during the first 7 to 10 years of your retirement. Now, why do I mention that? Well, first of all, you don't want to take a big loss early in retirement. We've talked about that, and we beat that drum, and other people have beat it as well, because it creates a massive pull down in your portfolio, and it's got to recover and last for sometimes 30 years. I think what people should be doing is looking at ways to generate income during that time period, because they're much more likely to travel and go and do the fun things that they've been waiting to do. So think about when you were a kid and it was raining and you couldn't go outside, and you're sitting inside and all of a sudden the sun comes out and you're like busting out the front door. This is back when we grew up. Graham, Richard, you guys are a lot younger. Y'all played a lot more video games than me and the listeners did. Right. But I was busting out that front door to go grab my basketball. I had that pent up demand of wanting to go play. Well, sometimes when you're in retirement, you have that pent-up demand of going to do things. So when you're much more likely to go and do and travel and spend more money, I think it's probably more advantageous for today's pre-retiree and retiree to start working on a way to protect their spending plan during that first 7 to 10 years and lengthen that time horizon and really protect themselves from, a big, massive downturn.
No, Chris, you said it really well. If we asked five different top economists, they're all going to tell you that we're in a different cycle. And so it really comes to, and a retiree their retirement portfolio is going to last through multiple different cycles. Doesn't matter where they start. It's really making sure that your plan can withstand all different types of cycles and storms and all of the above.
Mm-hmm.
I think my last question then, just real quick, if you could discuss the sequence of return risk and what it means. Why is it a risk to today's retirees?
Yeah, so obviously sequence of return risk, that's something a lot of people have talked about lately. We mentioned it quite a bit on the show. It is definitely a risk where, if you start taking money out of a portfolio and you're withdrawing on that portfolio, and now your portfolio is starting to see the up and down movement, that's where you start having what's called sequence risk. So we know that over a long period of time, the market's going to return a decent return. We also know that most of the time during our working years, we aren't touching that portfolio. It is just literally growing and we don't have to worry about anything. But the minute we start pulling money out of the portfolio, we introduce that sequence risk. And if you retire and you don't have a good retirement plan in place, and you see a large loss in retirement at the time when you're supposed to be going and doing all those things we talked about just a second ago, the traveling, the spending time with grandkids, taking everybody on vacation, and your portfolio sees a 20, 25, 30% drop, and you still need all of that money, you're going to be putting a lot of pressure on that portfolio. So this is where, when we talk about just retirement in general, we feel that your plan should dictate more than your personal feeling. So in some cases, I've run into situations where, I have, I guess, people that want to take more stock risk, and they're not really ready to do that. The plan itself won't allow for additional stock risk because of the pull rate on the portfolio. Their feeling is, I want to be more aggressive, but my plan won't actually allow it. So, Luann, I hope this segment was helpful. I'm so glad you're back. So I didn't have to do all of the talking today. I thought that was great. Graham, Richard, great input as you guys are sitting with people. We really appreciate your input and being here today. So if you'd like to set up a discovery session with us, you can do that by giving us a call, 256-937-2010. Again, the number is 256-937-2010. Hope everybody has an awesome and blessed week. And remember to serve every person in every situation with a servant heart.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by WG Insurance Services are not subject to investment advisory requirements. AEWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.